In this video, we're going to look at why do companies care if the share price falls? Stay tuned. Hey traders, a very warm welcome to you. Okay, so why do companies care if the share price falls? They've IPO'd, they've got money for the shares, they feel happy, it's chugging along, they're doing business, they're making money, they're getting paid as directors, employees, as managers. Why would they even care what happens on Wall Street or in the city or wherever they're listed? Why does it bother them? Let's look at 6 reasons why they do care. Number 1, the directors often have shares or options, so it means their personal wealth is tied to the share price. If the share price is going higher, their personal wealth is picking up. So they might either have a batch of shares that they've got stashed away, they might even be paid in chunks of shares, they might even have options, stock options that they can cash in and get shares for those options. So obviously, the higher the share valuation, the more money they're going to get. So there's a lot of pressure on. They think, you know what, my personal wealth is tied to this. They don't want to see their personal wealth halve or a chunk of it halve based on poor share price performance. So they're really concerned. They really want to see that that share price is pushing on and doing well for them. Number 2, very, very similar, employee bonuses. So those further down the rungs of the ladder, employees often will get bonuses paid in shares. And if they're getting paid, you know, half as much as they were last year, that's going to affect morale, right? They're going to be looking at the share price. They're going to be looking and saying, hey, we're actual shareholders now. We're getting some shares as bonuses or as part of a remuneration package, and it's not really worth as much as it was. This creates a bad kind of vibe within the whole company, you know, because everyone is being affected. It's like having a salary cut ultimately. So, you know, they do care, and it will affect how people are, you know, kind of operating, and as I say, the morale inside the offices. Number 3, are there underperforming competitors? It puts blame on managers. So in other words, you know, if you've got other companies in the same sector as you and their share price is doing very, very nicely and yours isn't, you're going to struggle to justify why that is. It's obviously not a market force because these other guys are making money and their share price is doing well. It's obviously a decision-making thing from within the company. And so the fingers are going to start being pointed. The blame's going to be start pointed on you as a manager or as a director or as a decision maker, whoever it may be. Shareholders are going to be saying, hey, excuse me, but other companies in this sector are doing okay. It's obviously not a sector issue. What are you doing internally that's causing this problem? So the pressure then comes on the shoulders of managers, of directors, of decision makers, of people running the company to say, hey, this needs to sort out. And obviously their job's going to be on the line if it carries on and they carry on getting the share price is getting hammered and investors have got no confidence in the share price, no confidence in the company, which results in a lower share price. Others have. This is going to cause a lot of problems in the management. So number 4, bad publicity, which could affect operations. So if we've got an extreme scenario, you know, the share price is getting hammered and hammered and hammered and others are staying up and it's not a market-wide thing, you know, if it's a market-wide thing, generally it's going to be forgiven because everyone's just going down with the tide and up with the tide. But if you're the one that's not performing as well as you should be, all of a sudden the publicity is going to be there. Bloomberg, Reuters, the financial press is going to be talking about it, and it could affect operations. In other words, it could affect your ability to do deals. If you go in there to do a deal with another company, you're going to be on the back foot a little bit because they know you're under pressure. They know you want your share price to be higher. They know that perhaps they could ask for a few more terms that are more swung in their favor than your favor, and it just may affect operations. You know, also if you're importing things or what have you, just general operations of the business could be affected by a weak share price, and people might not want to do business with you. You might think, hey, you might not be here in a couple of years time, so we don't want to commit to a 20-year contract with you, a 5-year contract, or to give you a contract because we don't know, you don't look in that good financial standing. So there is that. Number 5, ability to borrow money. So if you're going to a bank or you're going to a lender, you want to borrow some money, the first thing you're going to do is say, well, let's have a look at share price, look at company valuation. If they kind of look at it and think, well, actually, that's really poor. The share price has been going down for a while. Valuation is declining. They might give you money based on a forward valuation that's half or a quarter of what you are, purely because it doesn't look like the share price is that encouraging, and they've got to take a lot more risk on. Again, you could go bankrupt or you could be worth far less. They want to make sure they get their money back somehow. So it could affect your ability to borrow money. And number 6, the final one, guys, is that you're a buyout target. You know, if the lower your share price goes, the cheaper it is, obviously, the more likely maybe a wealthy investor, a rival can come in and start scooping up shares. That A, gives them a chance to buy you out if they buy enough shares. B, gives them obviously voting, so they're buying voting rights shares, the ability to have a say in what goes on in your company. It's just a kind of bad situation. You don't really want to be bought out in a hostile manner. If you're going to have a buyout, the perfect scenario for a buyer is for your share price valuation to be high, and then the buyer to pay a premium on top of that, and everyone's happy because they're making money, and then the buyer thinks they're going to make some more money because the way they're going to integrate it into their business means they're getting more value than what they've paid, and everyone's kind of working well. Whereas this scenario, when the share price is low, you don't want to be bought out. You're like, listen, it's fine, we're doing okay, unless obviously you're going bankrupt, a different scenario, but you don't want to be bought out just because your share price is low and because people perceive that the company's not doing well and you think it's doing okay. It kind of puts bad vibes, and it's not good for long-term success of the company. So 6 there. Any more you've got, stick them in the comment section below. See you in the next one. Take care. Keep the risk managed if you're trading. Goodbye.